Good afternoon, everyone. And thank you so much, David, for having me in this really unique presentation, in this unique event that you have created, the commodities and cannabis event, which is an amazing event because not everybody talks about cannabis, not everybody talks about commodities. So everybody is mostly stock oriented or futures oriented, and these are just left behind. But there are some beautiful gems that you can profit short term, long term into the market. So today I will be talking about how you can profit from the 2021 commodity bull market. We had a presentation, David, if you recall, back in January, and it was with the same theme. We talked about commodities, and we talked about the possibility of major breakouts in the commodities market as we were heading into the first quarter. The event was somewhere, I think it was January 6th or 10th, and we were talking about the potential of oil running higher. We talked about the potential of natural gas higher. We talked about the gold market. And if you guys are, can go into David's archives, you could actually view all of those presentations. It's going to be very interesting to see because I had a similar presentation about the commodity bull market. And you can see that I talked about natural gas, I talked about oil, and I talked about many other commodities that have proven right to this very day. So without further ado, let's begin the presentation. So as a risk disclaimer, please keep in mind that all information provided by TradeOutLoud is for educational purpose only. It should not be construed as investment advice. I'm pretty sure you know by now that trading involves a really high level of risk and may not be suitable for all traders and investors. So you should carefully consider your objectives, your level of experience, which is very important, your risk appetite as well, because you need to position size accordingly for all your trades. All right, so without further ado, let's get a little bit deeper into the presentation. For those of you that are very new here and do not know me, my name is Anka Metcalf, and I'm the CEO and founder of TradeOutLoud.com, which is a trading education company that is based on educating individuals. Was created to educate individuals how to day trade and swing trade the futures and the equities markets. I have been doing this professionally for the last 17 years. We provide top-notch education, and also we provide services that back up our education. And in fact, we do trade every single day the system that we teach with a very high probability in our trades. You could actually view the performance. I'm going to get into that towards the end of the presentation. I personally have over 10 years of investment banking experience before coming into the day trading and the swing trading arena, which I basically took it as a professional trader. So for the last 17 years, this is what I have been doing, trading from home and focusing on equities and futures. I also trade Forex as well. And because I did mention Forex, stay tuned and be on my email list because I am going to be in a trading competition next Friday. So you're going to hear a lot about it. I think I'm going to send an email about it, and definitely it's going to be on social media. So it's going to be very, very interesting. I can't wait. So I'm going to be in competition with another trader. So I can't wait for next Friday. And we're going to be trading the NFP numbers. So that's going to be super interesting. All right. So I'm also the designer of an institutional proprietary trading system. So what does that mean? A designer, right? So what I did is I designed the system, my unique system that is playing around obviously the technical analysis concepts, but I have created, because I have been trading for so long, I've noticed that there are certain times in the market when the market reacts and when the market when the market starts pulling back, especially if you're a day trader. So I have this unique niche in my system where I'm correlating the setups that I'm seeing in the market with the market tempo and with the market timing. And I'm also focused on price support resistance. But if you're only focused on supply and demand, that only represents about maybe 20% of the equation. So what I do is I look for confluence areas, areas that become reactionary in the market, that have more substance to them and more many more odds of reaction than normal supply and demand. And that's why most of our trades, in fact, I do have a batting average. We have a transparent track record, and I do have a batting average that exceeds 75%. So it's over 75%. We also have specific trigger times. Like I said, there are specific times throughout the trading session because I have been trading stocks my whole life and my whole trading career. I started trading stocks. And the reason why I'm basically right now only day trading futures is for tax purposes. Advised my financial planner. So I have been trading stocks for most of the time, and I still love trading stocks, but right now I am swing trading stocks, so not day trading stocks. But I come with a very heavy stock day trading background, and because we know that stock day trading is a lot more tedious and has a lot more attention to gaps, has a lot more attention to market tempo. I bring those elements to the futures market where futures traders are not aware. Typically, futures traders are futures traders. They really don't have never traded or very traded unsuccessfully the stock market. So if you will, if you want to become a complete trader, you have to get into these different assets. For example, stocks, you learn how to trade stocks, you learn how to trade Forex, you learn how to trade futures, and every single asset is different and has a different handle and it has a different reactionary level. So it's not one, let's say, technical analysis template fits all. I also have developed, like I said, specific trigger timings in the market where you have to match the location, you have to match the entry with the setup with the timing in the market. Because how many times has it happened to you where you see a setup, you take it, and then shortly after you get a quick trigger and then it fails? And that is because you are not focused on the timing in the market. You just have the setups, you just have the technicals, but you have no idea about these specific times. And I have developed these specific times and zones into the market. Needless to say that there are 4 specific price zones that are the best kept secret of institutional traders. They use them all the time to scale in and scale out. And these are fixed price points on the charts that 99.9% of the traders do not know where they are. They are applicable to stocks, to futures, indices, to commodities, to everything, and especially to Forex, All right, so I also focus on chart synchronicity and divergency. So chart synchronicity and divergency is very important. For example, on a day like today, you wanted to focus on something that has relative strength, which is NASDAQ, right? You had relative weakness into RTY, into Russell, because Russell was weaker. So even if you're trading stocks, IWO is weaker. The better possibility for and the better high odds were in NASDAQ. In fact, today we had 3 trades in NASDAQ to the long side, all of them. All right, so we also apply a strict set of trading rules and a 10-point scoring system that enables myself and my traders to identify trades with ease. And we actually trade stress-free, and it's really such a fun and awesome trading environment that we have in our trading room. And I specialize in high velocity moves. Now, there's a catch. High velocity moves are coming with a trend. And because now we're stuck, we're not trading in any kind of trend. We're not really descending. So we can't say like, oh, wow, we're in a downtrend. We're not yet. If you're looking at higher time frames throughout the charts, we're not in downtrends. This is just a pullback. And in fact, if you're looking throughout the charts, you can see that there are so many symmetry patterns that are happening right now in the market. The last time NASDAQ pulled back, for example, it pulled back in April. So it started pulling back in mid-April, and it stabilized in mid May. So for about a month. So it has been running down for about a month, right? So when did this NASDAQ, for example, or the indices for that matter, because they're all in sync here, we're talking about these pullbacks in the market. They started with the beginning of September, right? September 6th is the first time when they started to rotate back to the downside. They were very elevated. We know that, for example, indices, and I'm not here to talk about indices. I'm just giving you like a little bit of, kind of, let's see, if I could pull this chart out so you could see what I'm talking about. Okay, so you guys can see the screen right now. All right, because I've been talking about symmetries and all that stuff, and before we actually dive into the material. So I was talking about chart symmetry. As you can see here, this is a weekly chart of NASDAQ, for example. You could put the S&P, you could put the Dow, I don't care what you put, they're all into a symmetric type of pullback, and the symmetric pullback carried the price all the way to the 20 SMA. Now, if I zoom in a little bit on this chart so you could actually see the pattern formations on it, you would see that there's a common denominator. What is that common denominator? I'm holding my cursor over it, and that is the 20 simple moving average. You can see that every single time we had a pullback, this is the pullback that we talked about from the beginning of April, actually mid-April to mid-May, right? So over about a month, we were declined, which is not out of the ordinary. Why do you think it declined here? We were getting ready to close the earnings season. So the heavy part of earnings season was gone. And right now the price was a lot more susceptible to volatility. This is exactly what is happening right now. So we have just closed a quarter. There are very few earnings on our earnings calendar. And guess what? A week from now, we're going to get a little bit back into the fundamental side. So that means that the market is going to react more on the fundamental side than on the news side. Everything that's coming out of Washington, D.C., our regular calendar, et cetera, with our regular news announcements on our economic calendar that are coming in at 8:30, 10 o'clock, 10:30, et cetera, and throughout the day. So this is normal. As you can see here, we have periodic pullbacks that are happening in May. We have periodic pullback back in March, right? So you can see that these are quarterly pullbacks. And they all have one thing in common. This is the November pullback that we had. And notice last year, it is known that October is a really volatile month, right? Really volatile month. So you can see here that in October, we started to decline and we visited the 20 SMA. Before that, we have the September, right? So September, we rallied, October, we pulled back, and then we have the pullback. So the 20 SMA is the common denominator of this price action. Okay, so I just wanted to pin that out. Nothing, no drama, no nothing. So unless the price proves one direction or another, we could still respect the trend. So the trend is higher. If you see it on the weekly chart, the trend is definitely higher. All right, so let's get into the material for today. If you guys want to follow me on my social media channels, on Facebook, on Twitter, on YouTube, or LinkedIn, our handle is TradeOutLoud, or if you want to visit our website, it is TradeOutLoud.com. All right, so we're talking about commodities. Everybody that talks about futures, they probably know about, the Dow, the S&P, NASDAQ, Russell, et cetera, or the VIX, right? That you can trade via futures. Not a lot of traders know that you can trade, for example, oil, or you can trade gold, or you can trade cotton. Cotton, by the way, really massive move within the last few sessions, and also lumber. And I did post on Twitter earlier this morning before I started the trading room that I am building a position, and this is my first leg into lumber, because lumber is consolidating very bullishly. And you heard it here, and we can revisit it again next year when David is going to organize this event again, the commodities event again. Probably is going to be next year. So we're going to revisit lumber then. So it's very important that we have these videos as a timestamp to see how these patterns are working and how I am trading and how the performance works. All right, so you can see here, actually natural gas today hit over $7.22 or 25 cents, which is a record high for the year. Oil just made a new high as well for the year. It just rocked all the way to $79.78. And these were trades that were setting up. They had technical patterns and they had the reason behind it. So a lot of traders that think about the futures market, like I said, don't think just indices. There's so much more. And the life is really simple when you're trading these really big, hefty markets. And there are like so many advantages to trading these versus the ETFs. But you can trade both. It depends on your style, depends on what kind of account size you have, etc. You could also trade the dollar, you could trade the euro, you could trade the yen, etc. But because we're talking about commodities, and by the way, there's a huge move that happens in oats. There's a huge demand for oats. I have traders in my trading room that are invested into oats, that have been swing trading oats, that have been, holding to oats. For example, there is going to be a demand for wheat. There is going to be a demand for soybeans, but seasonality is going to play a major role in these commodities as well. So when you talk about commodities, there is a little bit more to them than technical analysis. You have to match the seasonality. We're going to talk a little bit about seasonality. Back in January, I was presenting you guys with this slide, and at that time, lumber, the VIX, because the market was pulling back at that point. We had silver rocking higher, we had NASDAQ canola, we have soybeans higher, copper was higher, natural gas was higher. So you can see that natural gas started to move really early in the year. Okay, so this was through 2020. Okay, this was an year to date progress into these commodities and indices and currencies as well, from 2020 all the way to January 2021. So this is what this performance represents. Now let's take a quick look at 2021 market and what is leading. Natural gas. Take a look at natural gas right here. Natural gas is leading, heating oil is leading, gasoline RBOB is leading, oats. We have crude oil, we have Brent, we have ethanol, we have coffee that is leading, we have canola, soybean, cotton, sugar, and copper that is leading. You can see like a bunch of commodities that are really leading for the year. And we have some laggards like soybeans, palladium, silver. Silver is lagging, lumber, but lumber I just mentioned, getting ready to bottom. All right, so if you don't want to trade the commodity per se, because you don't have a futures account, which I don't see a reason why you should not open a futures account, and we're going to talk about that shortly, you could trade the ETF. So if you're a stock trader, there's no reason why you should not be trading USO. USO is a trade that I have initiated last year when it was, remember when oil went negative? Well, I picked it up at about $2 and I loaded more in my other account when it was trading at about $4, and then it split. Remember the split that it had? And then all of a sudden it became, it went into the $11 and $12 area. This is the bottom right here. This is the first rotation that I legged into, and I actually went into for a short squeeze. But shortly after, because I saw this range develop, you see these lows that were never violated, we continued, and I decided to leave this position alone. So I went in and out several times in my other accounts. However, in this account, I just left flat 1,000 shares, as you can see right here. This is the USO, and this is actually from yesterday's trading session. Okay, this is not updated for today. Today, I'm way up on it. But imagine if you would have gotten this as well, like I did, and this is just 1,000 shares. And what is the risk, guys? Think about the risk. When I bought it, it was $2.24, $2.24. So what is the risk? Zero. Okay, so your position size for zero. So that's what I'm talking about, the commodities market, right? Remember when natural gas was trading at, I don't know, $1.70 or $2? What do you think gas is going to disappear from the face of earth? Buy with both hands. This is what the commodity market is for. And these are long-term holds. Okay, does that make sense? All right, so let's move on to natural gas. This is the natural gas right here. And in fact, this is the ETF, and it's not the, we could go over some of the charts. They're very similar to the futures charts. So the setups are the same. And you can see here that the price dipped. And then we had a really nice rounding bottom formation with a higher low. And once the price lifted over these, over the 50 SMA, it started to ride off in a power trend and started to follow the 10 exponential moving average. Is there room higher for USO? Definitely it is. You can see these prior highs, which are in the vicinity of $24. And also notice where the price is trading at right now. And this is a chart that I took last night. Look at the left-hand side. All right, look at the left-hand side. And by the way, if you're wondering which year was that or what time frame this is a weekly chart, and these are the low levels from 2018. So right now, the price of natural gas rose above the lows of 2018 here. And you can see that we have much more room to the upside as we're going higher. So this is definitely a buy on any kind of pullback. There's going to be a huge demand with natural gas, with UNG, whether you're trading futures or whether you're trading the ETF. Let's talk about something else. I posted this on Twitter. And I posted this before it happened because I love to post things so people can see the methodology at work. We're talking about seasonality, we're talking about technical patterns, and the transparency. So I'm not going to say, oh, I got an oil and I'm in oil, okay, and I have been in oil for so long, but I've never communicated with anyone. So I like to keep my Twitter feed, for example, as a timestamp. Yes, I did that, okay, to prove that, yes, I'm in a position, or I'm not. So this is a trade that I pointed out on August 10th as a weekly buy. Okay, and take a look at this really cool pattern formation. It's coming from lows with higher lows, and the lows are continuing to rise, and any kind of rotation off of this point can lead for higher. So again, you could either trade it via commodities or you could trade it via ETFs. It's up to you, your preference. All right, let's talk about gold. A lot of discussion goes around gold. Gold has not been performing has not been performing for a very, very long time. And in fact, I want to point out gold right here, gold futures. And let's go to gold futures right now, because I want to talk to you guys a little bit about the macro look into it. And this is the monthly chart. So I'm going to squish it a little bit more so you can see what we have to the left-hand side. This was the high, and this was the all-time high that we had in September 2012. And in 2020, we knocked this high out and we made a brand new high, 2089.20. This is a pullback. This is a big, big, big push that we had in 2019 and 2020, which we took advantage of. And right now, the price was so elevated from any kind of support level. As you know, every single time when a commodity or a stock or an index or whatever you're trading is hitting resistance, it has a tendency to stabilize. So what that means is either creating a shallow pullback or a range. And this is in fact where gold is at right now. It pulled back to the 10 EMA, it tried to rotate, it failed. It pulled back into the 20 SMA, but it's trying to root into this bigger, wider, let's say, formation. So we do have support, which is coinciding, if you look to the right-hand side, with the 50 SMA right here into the 1529, but we're definitely elevating higher. So we're holding into these highs right here. So right now we have support into the level of 1675, and it's actually very constructive. I would like to see it pop over the 1837. If it pops over these highs right here, the 1837, the 1835 to 37, it's going to start charging higher with the profit target at least into the 1900, but it's still going to take some time. I'm also going to revisit silver with you guys. So silver is, again, the macro look on silver. You can see that I have some levels that are traced. And there is a big line in the sand that is at $21.80. And you can see that we're revisiting this time and we're trying to form a bottom into this area right here. Now, it's very early in the month. It's just the beginning of the month. And we haven't completed any kind of formation. But throughout this month, if we break the $24.91, the price is going to start moving higher. If we break below, there's a very strong chance that we're going to be revisiting the $20. Now, like I like to say with these commodities, and I'm circling back to what I have mentioned earlier, silver and gold. You see silver and gold going to zero? No, it's just a matter of risk tolerance. How long and how much of a position do you have in them? Because if you're a long-term trader, and I do have long position in silver, I've had it for a few years. I have position in gold. I've had it for a few years. I have added more this year. So if you're a long-term holder, you're looking at a horizon of about 4 to 6 years. It all depends on on your risk tolerance and on your time horizon. So these are not going to be fast trades. All right, so in this image right here, we have a chart of GLD, which you can see that we have declining tops, but we're also squeezing. So if we get above this trend line, we will start obviously moving higher. This is a little bit of a intermediate look because it's a weekly chart. It's between the monthly and it's between the daily. So stabilizing support is at 157.20. We break below the support, there's a strong chance that we're going to be revisiting the 145 levels in GLD. Now, I mentioned earlier seasonality, right? seasonality affects commodities, right? Seasonality by itself does not make a trading system. So it's very important to note that. So for example, don't buy crude oil just because there's a colder weather outside, or natural gas. Okay, these are based on the supply and demand. And obviously now we're dealing with an energy crisis. Wow, who'd have known, right? So we're dealing with an energy crisis, and that's why the prices in crude oil and natural gas, boom, are going through the roof. Seasonality cycles are helpful indicators that can be useful, and a very useful indicator in our trading toolbox, because when you're trading commodities, you have to make sure that you're in sync with the seasonality aspect of the chart, and you're in sync with your chart pattern and your technical analysis. So there's a little bit more. That's why a lot of traders, and if you talk to any brokers, I have a lot of friends that are brokers, and they're telling me that most of the losses that they're seeing in the futures market are from retail traders that are trying to swing trade these commodities. These are long-term hedges. These are long-term positions that that institutions are building, or everybody that wants to hedge within these commodities are building the position. So these really short-term traders, like, we're going to try to squeeze a profit in corn from, let's say, from this level to this level. Yeah, it's okay. You can do that. But the bigger portion of the profit is going to go into the long-term trader. So seasonality cycles are a helpful indicator that can be a very useful indicator. Like I said, always match your technical pattern with the seasonality chart of your commodity, or even the index that you're trading, and you will have a lot more confidence in going long or short or wherever you want to do. It's going to help you in day trading. It's going to help you in swing trading, because you're not going to go against the trend. You're not going to go against the seasonality. And why fight it? All right, so most commodities are subject to the laws of supply and demand during the course of a year. So for example, for agricultural market, supply is dependent on the harvest, the planting, the weather conditions, and transportation systems, right? Transportation. So these transportation systems, they're running on what? They're running on gas, right? They're running on gas. So what do you think is going to happen with the commodities market? What do you think is going to happen to, what happened to, it's strong demand, and we have the transportation system, right? So we have two factors that are contributing to higher prices. Demand is influenced by cyclical consumption, export patterns, and also feed demand. So seasonality refers in particular to time frames when stock sectors, indices, commodities are subject to and influenced by recurring tendencies that produce patterns that are apparent in the investment valuation. So tendencies can range from one, weather events such as temperatures in winter versus summer, probability of inclement conditions, and also calendar events, quarterly reporting expectations, announcements, etc., crisis, or whatever it may be, right? So the key is that the tendency is recurring and provides a sustainable probability of performing in a manner consistent to various results. So it's a cycle, right? So let's take a little bit of on seasonality. Let's say in commodities, right? So on the right-hand side, you have the commodity: gold, silver, copper, palladium, crude oil, natural gas, live cattle, soybean. So from this calendar, you could actually really easily see when is the commodity, when the high demand for the commodity is. So for example, in gold, you have July through October 10th, right? So that is typically when the price in gold tends to rise a little bit. Now, because of the economic conditions and everything that is going on in the world, and because we're still dealing with the pandemic, we are still into the same flat level into gold. So gold has not imploded or exploded. Silver is going to be typically goes on demand starting with December 15th all the way to February 21st, and it has a spike around August. Copper goes on demand, and it is the seasonality for it, December 15th, and it continues through April 19th, has a spike around July. You saw the prices in July rise a little bit in copper. Well, it's not only the technical pattern, but it's also seasonality, and so on and so forth. You can see the seasonality on all. And let's talk about industries: agriculture, airlines, autos, banks, biotech, gas utilities, oil services, etc., railroads, telecom. Everything has a subject to seasonality. And if you look at these seasonal patterns, it's also for example, if you want to trade something like, I don't know, like Apple, all right? So you can look at the tech sector, for example, and you can see how is the tech sector seasonality based on based on the technical chart, and where are you located right now within that graph. Major indices, not a lot of traders know that, hey, there's a seasonality for the Qs, the SPYs, there's a seasonality for diamonds, there's a seasonality for futures indices, for example, for NASDAQ futures, for S&P futures. So I take into consideration everything when I trade. I take into consideration the seasonality. That's why I have such a high win ratio, because I take into consideration these elements on the charts. So seasonality, let's talk, because we talked about the Qs, right? Let's talk about the seasonality. Where are we at right now? We're in the middle of the chop fest. There's always, October is very volatile, and September is by definition. So August, let's begin with August. August, September, and October are typically really volatile months. August tends to run a little bit more into the directional bias, and the prior directional bias usually a little bit higher, because it still has a lot of companies that are reporting earnings. But once September hits, there are so many elements in September that create a lot of divergence in the market and create problems in the market. So by problems, I mean you have the futures contract roll that is happening in September, and that is going to produce a chop fest into the market. You also have option expiration, not only option expiration, but you have the quadruple witching option expiration. You also have the expiration of the futures contract, not only stocks. So, and then towards the end of the month, you can expect the price to remain pretty much sideways, because you have all of these elements that are going to produce a lot of hesitancy into accumulating or distributing the asset or the index in this case. So this tendency tends to continue into October. October, by definition, is one of the most volatile months. So like I said, the volatility, the heaviest volatility of the year is August, September, and it actually tends to wrap up into October. One of the, and I just want to mention here that one of the heaviest volatile year that we had was 2018. Wow, was it ever volatile? We had a strong volatility into the first quarter, and we had strong volatility in October. In October, we had a really strong volatility that continued throughout the month of November and December. So it was that big. Typically the years, seasonality shows that the volatility tends to subside in the latter half of October. And if you're asking, if you're asking yourselves, like, why is that? Well, because in October, you have the beginning of earnings season. Earnings season starts a week from today. So we have JP Morgan, we have Citi, and we have Wells Fargo that will be reporting. I think they're going to already be reporting on 13. I have to check the calendar. But then we're easing into earnings season. So I'm not going to say that this volatility is going to go away in a week from now. But what I'm saying is that it's going to bring a little bit more normalcy to the market, because the market is not going to be subject to these whiplashes from volatility up and down, because the market is going to respect more the fundamentals side. So earnings are going to come out, the market is going to react based on earnings. Now, remember that if the economic environment around the earnings, even if you have, let's say, Citibank that is going to report extraordinary earnings, okay, you're going to see the stock probably go up a little bit. But if the general economic, let's say, outlook is going to point towards recession, you can have a plethora of stocks reporting extraordinary results, because the market is going to go down. They're going to pop up a little bit into earnings, and boom, down they go. All right, so it's very important to keep in mind when you are trading, what you are trading, the environment that you're trading in, the seasonality and everything. So trading is very complex, and this is what we teach in our classes. This is what I talk about in my trading room all the time. This is what I teach my traders, to be complex traders, because traders that only see, oh, there's a red candle, I gotta go long. Ooh, there's there's a red candle, I gotta go short. Oh, there's a green candle. They're never going to make it into trading, because trading is complex. Guys, we are trading with or without, with or against hedge funds, against institutional traders, algorithms. So you pick your side. You want to be educated. You want to be a global trader. You want to know exactly what's happening in the market to have the right approach. You have to become educated. If you don't, you're going to pay it one way or the other. All right, so we're here into the process right now, into the Qs. So this is the weekly chart into the Qs. And as you can see, we're pretty much having this chart. It's from last night. I just added it to our slides so we can have really updated. So we haven't taken any new lows in here. We can see that we have strong minor support that is coming into the $342 area, and from this point we can expect a rotation. Remember, we talked about the rooting into the 20 simple moving average, so keep it super simple when it comes to trading. All right, let's talk about the S&P. Right, a lot of you guys trade options in S&P. A lot of you guys trade day trade the S&P, or trade the mini S&P futures, or do you trade the SPYs? So where are we in the process? Look at this, guys. We can still expect a little leg down before we start rotating higher. This is coinciding, ladies and gentlemen, with going a little bit in, let's say, into the mid towards the end of the month. Right here, when we're going to start to stabilize, and seasonality shows that we may be going higher. Now, remember, this may not always be the case. We had an exception to the rule in 2018, where we had that really big volatility spike, and we had the trade wars and everything, and the market took a little steeper pullback. But this is where we are in the trading process in the S&P. This is the S&P chart. This is the SPY chart, the S&P chart. So as you can see, it's SPY chart actually. The S&P chart is a carbon copy, obviously different prices, but we are into a minor support level. So that's why you were seeing the market trying to hold, right? You saw the market trying to hold today, right? So that's why we are trying to hold this level. If we don't hold this level, down we go. We go to about 400 level, 400 to 403. So this is very important to hold. We don't hold this area right now into the 425 to 427, let's say the 425 level. And if we're going to close below this, we're going to down we go. And this is the last level of support. And we have a confluence level here. We have the prior lows, and we have the 50 SMA right here. All right, so speaking about continuing the seasonality, right? So you have seasonality for energies, materials. So you have for sectors, each is subject to a seasonal chart. All right, so let's take a look at the seasonality in gold and silver. And as you can see, we're trading into the month of October. So in the month of October, it tends to stabilize. You can see a double bottom effect in gold, which is really corresponding with the technical chart pattern that I showed you guys before in gold, because we're really flat right here. And it has a tendency to rise in price as we're getting outside of October and going into November and December. Now, silver is a lot more choppier. And as you saw, the technical chart that I showed you earlier is a lot more choppier and typically likes to dive a little bit and root a little lower into the beginning of October before it tends to stabilize towards the mid of the month before taking off. So it's a lot more choppier in pattern than gold. Now, when it comes to these trades, we talk a lot about seasonality, but let's talk about, how we get into these trades, right? So how do we find these trades? So first of all, you have to have really strong technicals. You have to know how to trade. You have to know trends. You have to know technical analysis. So you have to know the whole thing in order for you to get the best high odds trades. And you have to meet the criteria of seasonality as well. So you need to focus on entries, right? Entries are determined by support areas and by confluence areas. Remember, I mentioned about the confluence areas, so you have to have at least 2 or more areas of support that overlay into the same price area. Stops can be used. So these are elements that you need to have on any trade before you actually get into a trade. So you need to have a stop, whether you're using a hard stop or whether you're using a flex stop. A hard stop is placed on the technical pattern, where a flex stop is a mental stop. So when you're using mental stops, you're looking for a longer time horizon, but you're still positioning for your trade. So ultimately, you have to have a stop from which you calculate your position size. And ultimately, if you're looking for a long position, you're looking for a stop to be placed below a pivot. Typically, that is formed on a higher time frame. For example, a weekly chart, a monthly chart, or why not, if you're holding for a long term, you're looking at quarterly charts or even annual charts. And of course, based on the parameters for the entry and a stop, you want to calculate targets. Whether the asset is trading into all-time highs, there are tools that you can use to calculate further projections higher that institutional traders look for, because they need to have measured moves, and you need to have measured move as a trader as well to see if it's worth for you taking the trade where you were taking it and applying the stop that you're applying. And I think the fourth thing, but I think one of the most important ones, is the risk and risk to reward ratio. So when you're talking about risk, the difference between the entry and the stop is going to provide you the risk. Now, there are so many traders out there, and I don't know why, but in the futures market, there are so many traders out there that, have no idea how to position size. In fact, it's super easy. But what they do is they think that, they start with the misconception that, let's say if they have a $50,000 account, they're going to take 5 contracts or a standard of 3 contracts, which is not the thing, because you're all over the place if you do that. Sometimes you're going to get a 5-point stop. Sometimes you're going to get an 80-point stop. So how's that going to help grow your account? You need to have a really good understanding of calculating your position sizing, because without position sizing, your account is going to be all over the place. You're never going to progress. It's going to be very hard. You have to be really good to progress if you're doing that. So when entering a trade, you have to consider, so first of all, there are 2 types of trades, or let's say 3 types of trades. There are day trades, swing trades, and investing trades. So in day trades, for those of you that are new here, in day trades, usually the position is held from a few minutes, let's say from a couple of minutes until and it could last for a couple of hours, or until the session closes. So that means that you're getting in and out within the same trading day. And in day trades, you have to consider the trend, the timing, and the location, obviously, as with any kind of trade and with any kind of technical. Now, in swing trades are typically held from 2 days to about 2 weeks, or even longer, depending upon the environment of the market. If you're seeing that the environment is sideways and the price is not going anywhere, and nobody gives you the right to exit the trade just because you're bored into the trade, no, you stay in the trade as long as your stop holds. And if you're a sitting duck in the trade, you have no choice. You have to sit there in the trade. So don't take yourself out just because it's not going anywhere. It will explode or it will stop out as soon as you get out, I promise you. And then there is the investing. I didn't add it here, but of course there's the investing side. I do all 3 styles of trading. So the investing side, typically you hold positions from, let's say, 2 years to about 4 years, 8 years. I have positions that I hold I've had for really many, many years, 20 years, 25 years. All right. So, trading is actually a rule-based system. So as you can see, there's so much more than green candle and red candle. So you have to understand the rule. That is actually the easy part of trading, and learning how to trade and finding a system that works is imperative for the success of your trading career. So trading is a rule-based system. It's not about only finding entries, finding stops, finding targets, and all that stuff. No, it's about how you put everything together and how fast you can process everything, because we live, and especially if you're day trading. I mean, we're talking about day trading, right? So if you're day trading, you have to be like super fast because you're competing with algorithms. So finding high odds trades, you can find high odds trades by respecting a really good system. Have the patience to wait for the pattern to form. If you don't see a pattern, you don't take the trade. So don't rush into anything and don't overtrade, because individuals that overtrade are not educated. They don't know better. So they chase the price. They're already like, oh my gosh, what am I going to do now? What am I going to do? I'm going to get in now. I'm going to get it out now. So that's how you blow up your account. You have to wait for the setup. You have to have a really fine and precise execution. And in fact, if you're trading on any style of trading, day trading, swing trading, or investing, you 90% of the time is waiting for a trade to set up. And if you don't know what a setup is, then you definitely should stop trading right now. And of course, money management skills. What are you going to do when you hit target 1? What are you going to do if you hit target 2? What are you going to do if you hit target 3? What are you going to do if if the stop goes against you? I mean, these are all things that go hand in hand with position sizing and money management. For example, everybody that day trades should have a budget, right? And depending upon that budget, you divide that budget, that daily budget, into 3, for example. If you want to take 3 trades a day, for example, I do. In the futures market, I usually allocate it 3 to 4 trades a day. But if you're a stock trader, you can allocate a little bit more, right? Because obviously in the futures market, you're not going to have as many setups that you have in the stock market. In the stock market, you pop a stock, you can find a setup. You can find 50 setups in 5 minutes. So the futures market, you have to wait a little longer. So that's actually a good thing. And of course, you have to have patience, because if you don't have patience, guess what? You're not going to have money in your account. So we're here to talk a little bit about futures, because we talked about commodities. Commodities are a big part of futures. Like I said, you can trade them via ETFs if you don't want to trade them through futures, but there are so many advantages trading the futures market. And if you're like me and don't want to pay 40% or 50% taxes, then you should definitely look into the futures market, because you may have IRS advantages as a full-time futures trader. So talk to your accountant to look into that. With futures trading, you can take on a short position with these. You don't have the uptick rule. You guys know that are trading stocks, you know what I mean? Because for example, if you are scanning and if you find a trade that you want to short and you're not paying attention, it could be hard to borrow. So therefore you cannot short it. In the futures market, you can short whatever you want. You have the advantage of buying power, because typically you have a really small margin requirement to trade the commodity. And I mean, tiny, tiny, tiny compared to ETFs. You have reliable volume. You're trading major markets like gold, silver, indices, etc., even VIX. It is an income producing style of trading, because you can day trade it, or it could be wealth generation. You could swing and actively invest, for example, in gold and oil, etc., or natural gas, or whatever the case may be. You have tick values in different price ranges. You could trade minis and micros. There are minis and micros available for example, for many commodities like gold and silver, etc. You don't need to use, besides ETFs, you don't need to use a scanner. You don't need any special indicators. And you have a lot of tax advantages. So make sure you look into that. That I should actually make that bold, right? Because it's like we're working and we're getting half of what we're getting, whatever earning. No manipulation, no downgrades. And first of all, it's a 24-hour market. You have hands-on risk, which is absolutely amazing. Account size. Well, guess what, guys? You cannot day trade if you only have a $25,000 account. You have to have a little bit more, at least 30K, in order to day trade. But in the futures market, you can open an account with 5K. So that means that you have $5,000 account, you can start trading. So it's a lot more, there are a lot more advantages. Plus the stock market, like I said, I have nothing against, and I love the stock market. I actually am in the stock market every single day because I swing trade every day. I take active swings, medium-term swings, longer-term swings, and invest. So the stock market is open from 9:30 to about 4 o'clock. The futures market, 24 hours, guys. So you can take advantage of this 24-hour cycle. So we trade with a really structured approach. If you want to trade with us, like I said, we trade with a really strong structural approach. We teach traders how to trade live every day, a highly successful system that follows institutional money and enables us to profit from momentum moves. And here's the specific times, locations, precise technical patterns, and seasonality. And our method overrides any kind of news event, our official indicator, earnings, and dark pools, because we know and we get ahead of these dark pools oftentimes, but dark pools help a lot to our trading as well. So if you want to trade with us and learn how to trade through stocks or futures, you can view some of the reviews here. We only have 5-star reviews. I think we only have 1 4-star review. I don't know. And that was, you know, the student that left me a 4-star review said, oh, I accidentally clicked the 4-star and left another review with a 5-star. So I'm not kidding. True story. So trade with an institutional grade trading system. Would you like to be in like the know and say what the heck is going to happen next in the market and know how to forecast and how to find these winning trades and make money like the rest of the institutions? Well, I teach a system that is stress-free, and you're going to be able to follow institutional levels, stress-free levels. You're going to know how to, the areas where to buy, to sell, the high odds patterns, how to put the puzzle together, because this is something that we do. And I don't think there's another company that does that. We put the puzzle together because trading is how you combine everything that you know together in a nanosecond so you can take action. So if you want to trade, if you want to learn how to trade, definitely, you know, look into our program. We have a really high rate of successful traders. You can come into the trading room and ask and see, you know, what we think. Like 99.9% of the traders that we have are students. We, you know, have traders that come in, you know, they have no idea how to trade. They go like, oh, you know, I don't know, you know, I'm out. But most of the traders that are in our trading room are in a know. So if you want to know how to trade, when, where, what, you know, advanced risk, technical analysis, et cetera, et cetera, et cetera. We teach everything from A to Z. And we're actually having, we have increased our prices for our courses. If you go to our website, it is $5,999 for our class. And we're offering actually right now, an early bird until September 15th. So we still have, sorry, it's October 15th. So there's a typo right here. It was very late when I updated these slides, by the way. $4,999 if you want to join until October 15th. And we have the class already scheduled for you guys. Let's see here. So I want to take you to, okay, here we go. Education. All right, here it is. So if you want to use this link, so by the way, use this link right now. It's TradeOutLoud.com/futures now. So if you use this link, whoops, okay, futures now, it's going to take you to a different page, because the page that we have right now on the website, you're going to have the $5,999. We also have a continuation. So if you want to take advantage of the trading lab as well. So we have 2 things. This comes as a continuation of the class. This is, let's say, a master class. This is a trading lab where we teach you, where you have another 5 days and where you're going to be taught a lot of other things. So if you're very, very new to trading and say, hey, we're going to take you from student to pro trader, this is the course for you. But we have a lot of traders that are hopping in on the $5,999. And like I said, there's an early bird right now, and use that link. I'm going to type it right here. So it's TradeOutLoud.com/futures now. Okay, so take advantage of that link if you want to sign up. You still have about a week to sign up with the preferred price of $4,999. And trust me, it's a really small price to pay compared to the losses that you can have in the market. And if you want to join our trading room and say, hey, you know what, I just know it all. Okay, even though I doubt it, but I know it all. So I want to join the trading room. Here is where you can go. It is the Futures Live trading room. This is the link right here. I'm going to just copy and paste it. If you guys are interested in diving, we have a lot of traders in the trading room, and I mean lots of traders that are phenomenal. We are, and there's a little disclaimer, I'm going to be out tomorrow, and I'm moving. So I'm in the whole process of moving, and I'm going to have the trading room open. My traders are going to be in there sharing their trading ideas, but I'm not going to be there. So if you want to join, you can join now, because whomever joins now is going to have access to a class that I'm going to be teaching. It's going to be a mentorship session with lectures, etc. But it's going to be at the end of October, when I'm finally settled in, to make up for these 2 days. And next week, I'm going to be out 2 days, as well as I'm in the process, like I said, of moving. Okay, so if you want to join the trading room, you can see it right here. You can log in, and we have let's say four options for you. You have the monthly, you have the yearly, you have a 1-day pass to see how we're trading. And if you opt for the 1-day pass, obviously it's going to be for next week, for Monday, okay? Because even if you sign up now, it's going to be for Monday, and the login, you're going to be receiving it on Saturday, or I think you're going to receive it on Saturday or Sunday. Anyways, so you have also a 5-day trial for the trading room, which is $100. If you want to say, hey, is this for me? Do I want to make money consistently? Yes, then this is for you. Okay. All right. So as you can see at the very bottom, we have futures performance, we have stock performance as well. We have full transparency. All right. So you can see here 2017, 18, 19, 20, and 21. And you can see the results in each month. This is February, March, whatever. You can go and browse yourself through these. Okay, so if you guys are interested, shoot me an email as well, info@TradeOutLoud.com if you're interested, and I'm really happy to work with you to make your trading work for you. And I'm telling you guys, trading is not going to be easy. I don't know if we're going to go into a recession, but you need to know how to trade, because you need to create an income. I mean, you need to hedge the future gas prices. Gas is going through the roof. What are you going to do? Okay. So this is it for me today, guys. Thanks so much. Have a great rest of the day. Many more traders are invited in here. David has a phenomenal panel. And I think Wally is next.